If the market falls 30% in your first year of retirement, your income may never fully recover. And that's even if the market does. Because if you retire, let's say with $1 million and it falls to 700,000 in the first year, then you're no longer growing from the same starting point. And then once the withdrawals begin, those early losses, they don't just hurt, they can change what the rest of retirement looks like. And that's why the first 5 years of retirement can often determine the next 20. So you'll often hear that the stock market returns about 10% per year. And over long periods of time, that's roughly true. But the thing is that in any given year, the market almost never returns exactly 10%. I mean, most years are either strongly positive, like 15, maybe 20, maybe sometimes even 25% or more. Or they could be meaningfully negative, maybe down 15, maybe 20, maybe even 30% or more. And that volatility doesn't matter much when you're still working and you're still contributing, but it matters a great deal once you stop earning and then you start withdrawing. So let's use a real example. So a couple retires in October of 2007, which was right before the financial crisis. And then over the next 17 months, the S&P 500 fell roughly 50%. Now, if they had retired with $1 million and they were heavily invested in stocks, well, their portfolio could have dropped towards $500,000 before the recovery began. Now, most retirees aren't 100% in stocks, but even a balanced 60-40 type portfolio fell roughly 25 to 30% during that same period of time. So that same $1 million might have dropped to, let's say, 700,000 to maybe 750,000. And during that entire decline, income was still coming out. Now, this isn't about predicting crashes. It's really just about building a plan that can handle them. And here's why. Here's what changes everything, really. Because yes, the market's recovered. Yes, it eventually reached new highs. But if you were withdrawing during that decline, then you weren't just riding it out, because money was still coming out. During your working years, a lot of times you hear that as you're saving and accumulating for the future, you'll be fine. You can just go ahead and ride it out. But when you retire and you start pulling income, the ball game is just, it's completely different, because now this is a situation where now you're selling when the portfolio was down. And every dollar that you pull out, it wasn't there now when the market, did recover. So when the markets turned back up, you had less working for you. Same long-term average, but very different retirement. That's sequence risk, or sequence of returns risk. So think about this. Let's say we have two retirees and they each start with $1 million. Both withdraw $50,000 a year. Both average 7% over the course of 25 years, but one gets strong returns in the first 5 years of their retirement. But the other, they get a negative 20% the first year, then a negative 15%, let's say the second year, then a gradual recovery, and then maybe stronger returns later on. They each end up with the same long-term average, but in many simulations, one portfolio lasts comfortably, and the other can begin experiencing income pressure much earlier on. A portfolio that might have supported $50,000 a year may now only safely support $30,000 or $40,000 after an early crash. And again, it's not because the average return changed, it's because the sequence did. Those early losses really, really matter, and especially when money is coming out, when you're taking income. Now, some of you may be thinking, well, I'm more moderate. I'm really not that aggressive. And, that's probably a good thing. I mean, most retirees probably shouldn't be invested 100% in stocks, but even moderate portfolios can fall 20 to 30% or perhaps even more, especially in severe downturns. Your allocation affects how much it falls, and withdrawals then will determine how much of that fall sticks. And timing decides whether the plan bends or whether it breaks. Major bear markets are not mild pullbacks. I mean, historically, we've seen declines of 30%, 40%, even 50% from the high point down to the low. And so if your plan's never been tested against a 30 or 40% drop early in retirement, then you really don't know how likely it is to hold up then over time. If you're within 5 years of retirement or within 5 years after retiring, then these are the years that matter the most, because at this point, your portfolio is likely at its largest point. Right? You've been saving and investing all these years and accumulating this money, now getting ready for retirement. And so this is a fragile point, especially those early years here in retirement. But after those first few years, the pressure starts to ease. But those early years really set the tone, because remember that markets will never deliver smooth, predictable returns. I mean, it would be great, but it just doesn't work that way. I mean, some years markets are going to be up big, like up 25%. Some years, like I mentioned, they're going to be down 30% or more. You know, volatility isn't the issue. I mean, volatility is to be expected. That's normal. But the issue is when it happens, and are we prepared for it? And if it happens early, when you've just retired, now income's coming out, that's when it matters more. If you've never modeled what a 20 or 30 or 40% early decline does to your income, you don't actually know how your plan responds. This is all why the first 5 years of retirement are often the most important financial years of your life. I want to thank you for watching, and I'll see you next time.